Hello everybody, my name is Winfried Heinrichson and this is part 2 of what operations managers should know about financial statements. Today we have to talk about the difference between income and cash flow. Let's start with a timeline. It is important because when we are dealing with finance and accounting, we are always thinking in periods. A month, a quarter, a year, we're always thinking in periods. So now we look at the current business year. Let's that have to be 2019. Let's say a customer stays in the hotel and pays for everything. Credit card or cash doesn't matter as long as the money comes in right away. We are not looking at the cost, the expense to provide that service. That comes later. Let's say the customer pays $1,000, which of course appears in the cash accounts, which means in the balance sheet. And of course it would appear as an operational cash flow in the cash flow statement. But it is also a service revenue. The 1,000 increase profit and therefore equity. As you can see, both sides of the balance sheet have increased by 1,000. We have 1,000 in cash, increasing the asset side, and since this is a sales revenue, 1,000 that increases equity. And we have a revenue and a cash flow at the same time. We have a revenue because a service was performed, so the company has earned the revenue. Now that was easy, so let's modify the example a bit. Let's say a corporate customer has its employees staying in the hotel, say in 2019, which means the service is considered to be performed by the hotel. But the customer is allowed to pay after receiving the invoice. That could be sometime in 2020. Now we will see that revenue and cash flow is not in the same period. The service was performed in 2019. This is when the revenue will appear in the income statement. This adds to the 2019 profit and increases equity. Since the customer hasn't paid yet, the unpaid invoice appears in the receivables, in the balance sheet. Both sides, the left side and right side of the balance sheet, increase by the same amount. In the example before, the increase in the assets was in the cash account. Now it is in the receivables account. Both times it was a revenue because the service was performed. In 2020, the customer sends the money and the cash position increases by 1,000. Then the receivable is removed from the balance sheet or from the accounts. In a way, the amount of 1,000 changes its position in the balance sheet. The receivables go down and the cash position goes up. And of course, the 1,000 cash inflow appear in the cash flow statement of 2020, because that is when the money arrived. So what's the difference between the first two scenarios? We say a revenue is realized when the service has been performed or the product has been delivered by the company. It is only then that the company fulfilled its obligation of the contract and has earned the revenue, no matter if the money has been received or not. As long as the invoice has not been paid, the receivable stays in the accounting system, in the books, in the accounts, in the balance sheet. And only once the customer has paid, which then is a cash inflow, the receivable is removed and cash appears in the cash flow statement and in the cash account. Don't ever confuse the payment with the revenue. The revenue happens when the service is performed or a product has been delivered. Now we change the scenario again. Let's say the customer pays in advance, which is a nice thing. The company has the money already, which means no risk with the customer not paying. The company has more liquidity, perfect world. But this is not a sales revenue yet. Why? Because the company has not yet performed a service or delivered a product. The company has not yet done anything earning that money. So how would that show up in the financial statements? In the balance sheet, it is money increasing the bank account, and you may have guessed it, it would appear in the 2019 cash flow statement as an operational cash flow. But as I said, the money has not yet been earned, so there is no revenue. Instead, the company has now a liability towards that customer. Therefore, in the balance sheet, the liabilities will now increase. Such a liability is called a deferred revenue. It is a liability going to be a revenue. Please note that this is not a monetary liability, since the company doesn't owe money to the customer. The company owes the customer a service or a delivery, whatever the deal is, and that is still a liability and will appear on the right side of the balance sheet. Please note that the balance sheet has increased on both sides by the same amount. Only this time on the right side it has not increased equity, but it has increased the liabilities. Then in 2020, let us assume the service was performed. Now these 1,000 will appear as a revenue in the accounting system. Since the company performed the service, fulfilled its obligation, this is no longer a liability. The deferred revenue liability is removed from the accounts, and at the same time, the revenue increases the equity, because that is what a revenue does. It increases equity. Please note that in a way, the 1,000 only switch positions on the right side of the balance sheet. Since now the 1,000 are considered earned, the 1,000 transform from being a liability to increasing profit and thereby equity. Keep in mind, unearned revenue is money received for work that has not yet been performed. Business people regard that as a good thing because it increases cash. But unearned revenue is still a liability. It becomes a revenue when the service has been performed or the product is delivered. So that's it for today. Thank you for watching. If you want me to clarify anything, just write your questions in the comments. I'll be happy to answer them if I can.